you know what's a hire purchase transaction? You know what's a hire purchase? Yes, yeah, it's that transaction that you know, Yeah, where you pay the deposits and then you take the possession of the item, and then the balance will be paying them in installment. So it's more of like lipa mdogo mdogo, but in this case, once you pay the deposit, you take the possession of the item. Are you together? It's not the one that you usually pay until once you finish the whole amount, that's when you take the item. And the hire purchase, you pay the deposit, then you take the possession of the item, and then the balance will be paid in installment. It's one of the specialized transactions. So when selling at hire purchase, is the price actually the same as the cash price? No. So in this case, due to the time value of money, it always attracts what we call the interest. So therefore, how do you determine the hire purchase price? So to get the hire purchase price, usually takes the deposits, that's the down payment, and then you add total installments. Or to get the higher purchase price, and also take the cash price, you add what? Yeah, because it will attract an interest. Good. Now, this interest factor becomes an additional income to the dealer, because from the cash price, there is a normal gross profit margin, and then an interest is an incremental what? Return. So in this case, for the firm that deals with the higher purchase, they have two sets of returns. One is the normal earnings, that's from the cash price, the gross profit, and then there's also the interest aspect. Now, how do we allocate this interest? How do we allocate for that interest? So let's go back to the notes. Discuss that. So interest can be allocated using the following methods. And one is a straight line method. So we are looking at methods of allocating interest income. And we have three methods. One is a straight line method. Then number two, we have sum of digits. Sum of digits method. And number three, we have the actuarial method. So under certain method, this is where you allocate the interest equally of the installment period. So for example, assuming you made a transaction of where you are attracting an interest of 10,000, and assuming the amount is to be payable in the next 5 installments. So we have 5 installments, and the interest income in this case is how much? 10,000. So when allocating this interest using the straight line method, you just take 10,000, you allocate equally. So how do you allocate equally? That means you divide by 5. So that means for every, sorry, this is 2,000. So that means for every installment that person pays, there is an interest of how much? 2,000, 2,000, 2,000. Then we have what we call the sum of digits. So how do you allocate the interest using the sum of digits? Assuming the same scenario, where you have an interest income of 10,000, and then you have 5 installments. So you sum up the installment. So 1 plus 2 plus 3 plus 4 plus 5 installment. How much is the total? Just take 1 and 5. You get how much? 15, right? So how do you allocate that? First installment, second installment, third installment, fourth installment, and fifth installment. Are you together? So how do you allocate that? So in this case, your interest income is 10. So you want to determine once this person pays the first installment, how much will be your interest income? So you take 5 over 15, 4 over 15, 3 over 15, 2 over 15, 1 over, can you give me that? Of 10,000, of 10,000. Just give me the first two. Give me the first two. That this is 3, 3, 3, 3, right? The other one is 2, 6. Yeah, like that. So that means on the first installment that person pays, the interest income is 3, 3, 3. On the second installment, 2, 6, 6, 7. The third installment, the fourth, until the fifth. Now that's what we call the sum of digit method. What if the installment period is 3 months? I'm a 3 installment. How do you allocate that? Assuming the payment is for 3 installments, you just take 1 plus 2 plus, and you get 6, right? So the first installment, second, and third, it will take 3 over 6, 2 over 6, 1 over, and then you multiply by the total interest. And then the last method is actuarial method. So actuarial method is all about discounting the cash flow you expect to receive. So actuarial method, you use the discounting method. So the first two are the most common method used to allocate the interest, sum of digits and the straight line method. Good. So let's go back to the notes. Then we have methods of accounting for hire purchase. Methods of accounting for hire purchase. And we have two major methods you can use. One is the interest method. And number two, we have the sales method. What's the difference between the two methods? So now let's be here. Now, under the interest method, in this case, you recognize the interest as a separate aspect of income. So in this case, we be computing interest separately, and then you recognize it at parts of what? Other income. But at the sales method, in this case, the interest is not computed separately because you'll be recognizing your higher purchase, your sales on higher purchase price. So that means under the interest method, you recognize your sales at cash price. And then under sales method, you recognize your sales at higher purchase what? Price. Once you recognize at cash price, there is an aspect of interest not recognized. So interest computed separately, and then you recognize as part of other. Can you underline cash price? Then you're saying that the interest is computed separately and considered as a what? As an income. Can you underline income? Good. Then number two, we have the sales method. Sales method. Now, under this method, sales are recognized at higher purchase price. Can you underline higher purchase price? Underline higher purchase price. And then interest is not recognized as a separate income. Yeah, because higher purchase already includes the interest. Good. So what are some of the accounts prepared under the sales method? Some of the accounts prepared when accounting using the sales method. We have two major accounts prepared. One, so accounts prepared. One is the debtors account. Actually, that's the major account they need to maintain, because in this case, they are selling on credit. So they have to show the amount they expect to receive back. Then number two is the repossession what? So you know what's repossession? You know what's repossession? Yeah, we're saying that in this case, under hire purchase transaction, you just pay the deposit, you take the you take the possession of the item. Now, what if you fail up to pay? Now the debtor will come for his item. Now that's what we call what? Repossession. Now the motive of preparing the repossession account is determined in case there is a repossession. Did you repossess at a gain or a loss? Good. So how do we prepare the debtors account? This is a normal account. Where being an asset, you always start with the balance brought. Those were the balance outstanding from the previous period. What increases the debtors? What increases the debtor? Yeah, the credit sales. Yeah, you add sales. Then what reduces the debtor? Once they pay, you reduce the amount of what? Your debtors. So cash receipt or the payment. What else? Bad. Yeah, bad debt. Also, in case there is discount, what? Discount allowed. Or else, in case there is repossession. You know, repossession was the data which you have previously been demanding from me, but in this case, we have repossessed the item, so reduce the amount, and then you determine your balance carried down. Now, this is what we recognize now to the statement of financial position. Then, what about the repossession account? How do we prepare repossession account? And you are saying that the motive of preparing the repossession account is to determine whether you repossess the item at a gain or a loss. So in this case, on the debit side, you bring the outstanding amount. Outstanding amount. At the date of repossession, how much was the debt outstanding? Then once you repossess the item, when taking it to the stock, you must take it a given valuation. So if you take, for example, assuming you repossess this laptop. So once you repossess, you can be able to estimate the value. So you take it to the stock at a valuation, and then you provide for what you call unrealized profit. Then you compare the value which you took that good to the stock against the outstanding amount. If the valued amount is more than the amount which was outstanding, that means you repossess at a what? Yeah, at a profit or at a gain. But if the amount outstanding is more than the valued amount, that means you repossess that item at a what? At a loss. Good. That's how you prepare those accounts. Now, how do we determine this unrealized profit? Unrealized profit is just a provision. And this is how you get the amount of unrealized profit. You take the outstanding balance or outstanding amount. You divide by the higher purchase sales. Then you multiply by the gross profit. That's how you compute the unrealized profit. You take the outstanding amount, divide by the higher purchase sales, you multiply by the gross profit. And when determining the unrealized profit, we compute both for repossession, unrealized profit on repossession, as well as on the outstanding debtor balance. Are you together? Of the amount you expect to receive, how much is your profit? So that's what you call the unrealized what? Unrealized profit. Any questions so far? Good, no questions. Now let's do an illustration. So you have a question in the handout. Do the question from the handout. Yes, handout page. Yeah, handout page 40. Handout page 40. That's the first question, question 1. So I want us to start with the one for sales method. I've said that we have two methods of accounting for hire purchase. We have the interest method and we have the sales method. So let's start with the sales method. There is that question for Ripopore. So you told that Ripopore Limited commenced business on 1st January 2016 as a supplier of refrigerators. All the sales are made on hire purchase terms, with the company taking credit for the gross profit, including interest in proportion to the installment corrected. How do you know it's a sales method? We are told that taking the credit of the gross profit, including the interest. So that means under sales method, we have said that under the sales method, you recognize the sales at the higher purchase. And the higher purchase includes both the cash price plus the interest. Throughout the year ended that 1st December 2016 and 2017, the total price, including the interest charged to every customer, was 50% above the cost of goods sold. Or in the case of repossessed goods, 50% above the value at which the goods were taken back into the stock. So our higher purchase price is how much? It's 100%. You add what? 50%? That's what we are told. Ama? We are told that, let's read the second paragraph. Throughout the year end that 1st December 2016 and 2017, the total price including interest charged to every customer was 50% above the cost of goods. Or in the case of repossessed good, 50% above the value which the goods were taken back into the stock. That means once you repossess the item, the value which you take that item to the stock, once you want to sell it, still you put a profit of how much? 50%. The hire purchase contract requires no deposit and provide for the payment of 12 equal monthly installments. The following trial balance was extracted from the book of Repossessed Limited as at that 1st December 2017. So you have the share capital and current assets, provision for depreciation as at 1st January 2017, hire purchase installment due less provision for unrealized profit as at 1st January 2017. What is that? That's our debtors. Are you together? Can you write that? In bracket debtors. Yeah. Hire purchase installment due less provision for unrealized profit. Yeah, we have, so that's what we expect to receive. So that's our debtors. Then stock as 1st January 2017 at cost. So that's the opening stock. We have the purchases, cash received from customers, bank balance. We have creditors, general expenses. We have revenue reserves as at 1st January 2017. Additional information. The sales including the interest for the year end that 1st December 2017 were 94,650,000. Number 2, in October 2017, the company repossessed some goods, which had cost 4.8 and had been sold earlier in the year. The unpaid installment on these goods amounted to 2.4 million, in respect of which nothing was recovered apart from the goods, which were taken back into the stock at a valuation of 2 million. The repossessed goods were resold before the end of the financial year. The total selling price, both on the original sales and on resale of repossessed goods, were included in the sales for the year ended that 1st December 2017. Number 3, all installments were paid on time, except for those referred in note number 2. Number 4, all goods unsold on that 1st December 2017 were in good condition and were to be revalued at cost. Number 5, provision for depreciation on non-current assets is to be provided at the rate of 10% per annum on cost. Required. Income statement for the year ended that 1st December 2017, and then statement of financial position. So how do we present that? So he said I have 2 major accounts prepared. One was the debtors account and what? Repossession. Yeah, repossession account. I've given you the format of repossession account. We have said that you take the outstanding what? Yeah, you bring the outstanding amount, then you take that stock back at a valuation. So you bring the valuation or revaluation, and then you make a provision for unrealized what? Unrealized profit. So let's start with the debtors account. Debtor is an asset, so therefore you'll be having balance brought down. How much was the opening balance of the debtors? Yeah, we have something we have indicated there, that higher purchase installment due, less provision for unrealized profit as at 1st January 2017. That's our debtors, an amount of 28,350. Then below it, we have cash received from customers. That one, this is the value of what? Debtors, yeah. Cash received from customers, an amount of, yeah, since we are selling on higher purchase, then what increases your data is the same? The sales. Note number 1, we are told that the sales, including the interest for the year ended that 1st December 2017, were 94.6. So during the year, we made sales an amount of 94,650. Good. Let's go to note number 2. Note number 2. In October 2017, the company repossessed some goods which had cost 4.8 million and had been sold earlier in the year. The unpaid installment on this good amounted to how much? 2.4. So if we repossess the good, and the outstanding amount was 2.4. You didn't expect to recover it back. Are you together? So that means it reduces your debt, your debtor. So you bring back your repossession, and the outstanding amount was how much? 2 point. Yeah, that means was already included during as part of the sales during the year. So an amount of 2.4. Then you credit the debtors account for the repossession. Then you see that under repossession account, you bring the outstanding amount, and the outstanding amount was how much? 24. Then let's complete number 2. I told that the unpaid installment on this good amounted to 2.4, in respect of which nothing was recovered apart from the goods, which were taken back into the stock at a valuation of 2 million. So outstanding amount is 2.4. Then they were taken back to the stock at a valuation of 2 million. Good. Then let's compute an unrealized profit. So how do you compute the unrealized profit? We say that to get the unrealized profit, you take the outstanding amount, you divide by higher purchase what? Sales, you multiply by the gross profit. And we have said that we compute unrealized profit for both debtors and possession. So first of all, let's get the debtors. Balance carried down. Give me the outstanding balance on debtors. How much are you getting? I just want the balance carried down. That's 975. So now let's compute the unrealized profit. We start with unrealized profit for debtors. How much is the outstanding amount? Yeah, it's that 9,970. You divide by the higher purchase sales. Note number 1. How much was the sales during the year? The sales, including the interest for the year, amounted to how much? 94,650. You multiply by the gross profit. How much is the gross profit? Sorry? That one? Let's be here. Let's be here. We want to determine the gross profit. Are you together? We are told that how much is the higher purchase selling price? Iko hapa. Sasa, we are selling at 150%. So what does that mean? So that means if our sales was 94,650, this was the sales for the year, is equivalent to what? 150 per? First of all, let's determine how much was the cost. What about 100%? We get the cost of those goods. You get 63? 63,100. Therefore, how much is our gross profit? You just take 94,650. You deduct the cost of 63,100. That means they had made a gross profit of how much? Sorry? That 1,550. So our gross profit is that 1,550. So how much is the unrealized profit on the outstanding amount? That in 325, 13,325. Also, let's compute unrealized profit on repossession. Unrealized profit on repossession. The formula is the same. So you said that we compute the unrealized profit for both the debtors and repossession. So how much was the outstanding amount on repossession? It was 2,400. You divide by the higher purchase sales. How much was the higher purchase sales? Now you take the higher purchase sales on repossession. Can we go back to note number 2? Note number 2. In October 2017, the company repossessed some goods which had cost 4.8 and had been sold earlier in the right together. So how much was the higher purchase sales? 40? higher purchases. The question is very clear. Let's read again. In October 2017, the company possessed some good, which had cost how much? What is 4.8? It's not 150%. 4.8 is the cost. Are you together? So you want to determine the higher purchases. If it had costed, if the cost was 4.8 and we are selling at 150%, 4.8 was the cost. Ama tumeambiwa aje? Which had cost 4.8. Now you want to determine how much was the selling price. If it had costed 4.8 and you are selling at 150%, so that means how much was the selling price? 72? Yes, so the higher purchase sales on the repossessed good was 72. Then you multiply by the gross profit. How much is the gross profit? How much is the gross profit? You are getting gross profit of how much? Perfect. It's 2,400. You just take, so you have computed our higher purchase sale, which is 72. Are you together? And the cost was 40. So they have made a profit of how much? 24. Give me that. 800. So their nearest profit on repossession was 800. So on a repossession account, we had a nearest profit of 800. So now you want to determine whether repossessed that again or else. So here we have is 28. Here we have is 28. There is a balancing figure of how much? 400. Gain or loss? Yeah, that's a repossession what? Yeah, we repossess those items at a gain. Good. So now with that, I think we can present our income statement. Yeah, we are supposed to present the income statement. So let's present the income statement. Present income statement. So Lipapore Limited income statement for the year ended 31st of December 2017. So let's start with our sales. How much was our sales? Note number one. How much was the value of the sales? Yeah, our sales was 94. Yeah, 94,650. Then you raise cost of sales. How much is the cost of sales? It's not there. It's not there. How much is the cost of sales? How much was the cost of sales? Don't look at the paper. You're looking at the paper, you are looking for the wrong thing. So we have computed together. Now let's be here. We have said that 94,650 is the same as what? What about 100%, which was the cost? So how much was the cost? 60 what? 63.1? Yes, as simple as that. So how much will be our gross profit? How much is our gross profit? Is that minus that? Eh? Which was that one? Yeah, it was that one 550. Are you okay up to that point? Then you add repossession what? Repossession gain as part of other income, an amount of 400. Then we deduct expenses. What do you have to the expenses? Let's go to note number 5. Note number 5. What do you have to note number 5? We are told that provision for depreciation on current assets were to be provided at the rate of 10%. 10%. So we have depreciation. You take 10%. How much was your value of PPE on non-current assets? It's 10,000. 10% of 10,000 is 1,000. There is another expense, unrealized profit provision. Yeah, that one becomes as part of the expenses. So from the debtors, we had 325, and also we had another unrealized profit on repossessed good, an amount of 800. So how much would be your total unrealized profit. 14, 125. Then we go back to the trial balance. What do you have to the trial balance? Do you have any other expense? The second last item we have is what? Yeah, we have general expenses, an amount of 16,150. So give me the profit they made. You're getting 670? 670. Kwa pamoja. Or alternatively, sometime you may need to separate the original sales and the repossessed sales. So also you can present like this. So we are presenting our income statement using another format. If you have to separate between the repossessed good and the original sales. So for the sales, show original sales and repossessed sales. Now, can we go to note number 2? Note number 2. In October 2017, the company repossessed some good, which had cost 4.8 and had been sold earlier in the year. The unpaid installment on this good amounted to 2.4, in respect of which nothing was recovered apart from the goods, which were taken back into the stock at a valuation of 2 million. The repossessed good were resold before the end of the financial. We repossessed and then we sold back. Then I told that the total selling price, both on the original sales and on the resale of repossessed good, were included in the sales for the year ended that 1st December 20. So required. So now required. If you present the income statement clearly showing the original sales and repossessed sale, how can we present that? Number one, how much was our sales? It was 90. Yeah, it's 94,650. You eliminate the repossessed sale. How much was repossessed sale? Let's go to the first part, the second paragraph. We are told that throughout the year ended, that 1st December 2017, the total price, including interest charged on every customer, was 50% above the cost of goods sold. Are we there? Or in the case of repossessed good, 50% above the value which the good were taken back into the stock. Now, once we repossess the good, how much of the valuation? It was 2 million. This was the valuation of 2 million. We want to determine how much of the repossessed sales. Then they were sold by the end of the financial year. How much was the selling price? We have read that statement. In case of repossessed, 50% above the value of goods. So we saw that. We multiply by what? 150. Even once we repossessed, we're also adding a profit of 50%. 50%. So on repossessed good, if they were sold and they had put a profit of 50%, so that means the sales was how much? So that means 94,650 included the repossessed sales, which is 3. So that means we had 91,600. Yeah, and then you can get your total sales, an amount of 94,650. Then you raise cost of sales. And the cost of sales also you have to separate for the original and for the repossessed. How much is it? Original? Let's be here. 91,650 is equivalent to what? Hey. 91,650 is equal to what? 150. Good. What about 100%? That's how you get the cost. Are you together? How much do you get? $61,100. Yeah, you just reduce the 2,000 from the repossessed. So you get an amount of 61,100. What about the cost of sales of repossessed goods? Was it not 2,000? Yes, or you can take 3,000. It's equivalent to 150%. What about 100%? Is it not 2,000? Yes. Now, can you give me the gross profit? Will it be the same? Will it be the same? That one 550? Yeah. So we can decide to use any of the method. Now, once we have that, now from there, you just copy what we have here. You add the possession gain, then you raise the expenses. So I wanted just to show you on how to separate between the original sales and the repossessed sales. But you only do that when I specifically require that. Then let's present the statement of financial position. Number B, that's the balance sheet. Lipapole Limited. Statement of financial position as at that 1st December 2017. So we start with the assets, non-current assets. So how much was on non-current assets? Yeah, remember there was a depreciation, eh? We provided a depreciation of 10%. 10%. So how much is our net book value? Yeah, 8,000, right? Then we go to the current assets. Current assets. So what do we have to the current assets? What do you have to the current assets? Sorry? Depreciation is how much? 1,000. The cost, how much was an non-current asset in the trade balance? 10. How much of depreciation? 1,000. So you get 9, eh? I told you the teacher is always right. Good. Can you go back to the trade balance? Did we have accumulated depreciation? Yes. Actually, below the non-current assets, there was a provision for depreciation by the beginning of the year. How much was it? 1,000. Plus there was a provision of 1,000. 10 minus 1, you get how much? Good. Let's go to the current assets. What do we have? We have what? Cash, eh? We have, no. We have bank, but now cash received. If you receive cash, does not mean you have the cash with you. So the cash you have is the one in the bank or cash in hand? In hand. So in this case, you only have the bank balance. Eh? Bank balance, an amount of 6,500. Then we have debtors. Debtors. Let's go there where you have the debtors account. How much is the balance carried down? That 9. Then you raise provision for unrealized profit on debtors. This is what we computed. Eh? Unrealized profit on debtors, there's an amount of 13,325. So give me the debtors. Yeah. Of the debtors. 26, 650, 650, and then we have inventory. We have the stock. Inventory. How much is our value of inventory? Stock. The amount of 66. Eh? Now let's go to equity and liability. Equity and liabilities. What do we have? We have share capital. How much is the ordinary share capital? $35. What else do we have? Hey, can you give me what you can see which goes to the equity? What do you have? Good. Revenue reserve. Revenue reserve. How much is the value of the revenue reserves? 51. Yeah, that's the same as retained profit. Then you add the profit for the year. How much was it? Yeah, 675. And what do you get? Sorry? 57.90. Then we go to the liabilities. Do we have any non-current liabilities? Yeah. We have what? Creditors, right? How much is the value of the creditors? 48? 4860. Anything else? No. Can you balance that or you see it will not balance? Others to add assets, others to add the equity. Assets or liability? Liabilities are how much? 45? 650. What about the assets? 47. You see, it's not balancing, eh? Yeah. What's the problem? How much is the value of the stock? Good. That was the opening stock. That's what you gave me. But we need to show the closing bar. Yes. Just take 45,650 minus that. Give me the balancing figures, the inventory. You're getting 4,500. Eh? Now, can you balance it? Will it balance? Yes. 45,600. Eh? That's how it should be. Any question? Any question? Can you look here? Because inaonekana hamjui kenye kinaendelea hapa. So how do you get the closing stock? Because umeniambia ni 45 na hakuna mwenye anauliza swali. Are you okay? Let me know, you know how where I've gotten 45. Eh? So we take a 1 minute break. Then we come, we do another illustration. Have you discussed what meant? That was not a discussion. You have just copied what is in the notes. How do you get closing stock? Purchase plus what? You just use the normal equation. Okay, how do you get cost of sales? Opening stock plus purchases minus closing. So whenever you're not given the closing stock, now can we make it the subject? Just take the closing stock the other side. So closing stock is equals to opening stock plus purchases. You take the cost of sale to the other side. So how much was the opening stock? 60? 600. Then you add the purchases. Let's go to the total balance. Are you given the purchases? Yes, an amount of 59,000. Then you minus cost of sales. But for the cost of sales, you only take for the original sales, because for the repossessed, it has been accounted twice, right? And the cost of sales for the original sales was an amount of 61,100. Or are you getting? Is that what you had discussed? Yes. I doubt that. Good. So we can see try another question. November 2017, question 5B. November 2017, question 5B. But we are not copying, you have the notes, right? No, we can't wait for you. You'll copy from the notes. Everyone has the notes, eh? Yes. It's not only the question. We have the notes, eh? The question and the solution. That's why I said you print the notes in advance. November 2017, question 5B. November 2017, question 5B. So let's talk on that question. And you are told that Reja is a small size firm selling electronic keyboards, both on cash and hire purchase terms. The following information has been extracted from the books of the account as at 30th September 2017. We have the share capital, general operating expenses, cash balance. We have cash received from the hire purchase customer. Then we have the cash sales, hire purchase trade receivables, property, plant and equipment, accumulated depreciation, retained earnings, provision for unrealized profit, purchases, trade payables. Also, we have inventory, 1st October 2016. That's the opening stock. Additional information. The company policy is to take credit of gross profit, including the interest. So whenever they say including the interest, know that we're using the sales what? Sales method. Including the interest for hire purchase sales in proportion to the cash collected. It does this by raising a provision against the profit included in the hire purchase trade receivable, not yet due. So that means you need to provide the provision for unrealized profit. Number 2, the cash selling price is fixed at 50% and the hire purchase selling price is 80% respectively against the cost of good purchase. So now let's be here. If you sell them on cash price, you sell them at you sell at 150 per, but if you sell on hire purchase, you sell at 1. That must be very good business. We're making a profit of 50%. And on hire purchase, you had an interest of 30%. Number 3, we are told that the hire purchase contract requires initial deposit of 20% of the hire purchase selling price, the balance to be paid in 4 installments at quarterly intervals. The first installment is due 3 months from the arrangement, from the agreement is signed. After the agreement is signed. Number 4, the hire purchase price sales for the year amounted to 70 million, including what? The interest. Number 5, depreciation is charged on property, plant and equipment at the rate of 15% per annum on cost. 1/3 of the depreciation is related to cash sales. Number 6, operating expenses is a portion on the basis of cash and hire purchase sales required. Prepare for a Reja Limited income statement for the year ended 30th September 2017, showing separate column for cash, hire purchase, and combined sales. Then number 2, you present the statement of financial position. So how do we prepare that? So first of all, let's determine the debtors account, because there was there any repossession? You don't have to read the question again. Kuna mali umesikia repossession? Good. Debtors account. You see, that's a very simple question, but you're going back to confirm whether there is repossession, and you have read everything. So how much is the balance brought down? Debtors. Yeah, you can't find it. 11. Good. They can't see it. They're looking for trade. It's hire purchase trade receivable. It's an amount of 13, 11, 34. Then what increases the debtors? The sales, right? Are you given the sales for the period? Yes, number 3. Number 4. Amount of 270. Then on the credit side, did we receive any cash? Let's go to the draw balance. Cash recovered from the hire purchase customer. Cash received from the customer during the year was an amount of how much? 157. 734. There was no repossession. There was no bad debt written off, right? So let's just get our balance carried down. balance carried on. Sorry? 113? 113,400. Now, once we have that, now we can provide provision for unrealized profit. And how do we get unrealized profit? You said you take outstanding balance, outstanding amount, you divide by higher purchase, sales, you multiply by the gross profit. For the debtors, the amount outstanding was 113,400. And how much of the higher purchase sales? 270,000. You multiply by the gross profit. So if the sales was 270,000 and the higher purchase price is at 180%, so this is the same as 180 what? Percent. Now what about 100% so that we get the cost? 270 divided by 1. And then you get 150,000. So therefore, to get the gross profit, if the sales was 270 and the cost is 150, therefore the profit is 120. 120. So 120. Good. So how much is the unrealized profit? 50? 54. Are you together? Yeah. Was it an increase or reduction? So because in the, let's go back to the trial balance. Did we have the provision for unrealized profit at the beginning? Yeah, we have provision for unrealized profit as at 1st October 2016. How much was it? Yeah, at the beginning, the unrealized profit was 50. Then at the end of the year, we have made a provision and it has increased to how much? 50 for her. Yeah, an increase in provision becomes an expense. An expense. In case you're not given the opening balance, you just work with 50 for her. 100. But since you are given the opening balance, you're given the one at the end. So how much was the increase? 49? 8? 8, 9. Now this is what you take the income statement as an expense. As an expense. Good. Then I think with that we can present our income statement. So Reja Limited. Income statement for the year ended. And the year ending 30th of September 2017. And then the question was clearly stated. What were the terms? Income statement for the year ended 30th September 2017, showing separate columns for cash, hire purchase, and combined. So we have cash sales goes on from the hire purchase transaction, and then you need to show the combined or the total. So let's start with the sales. How much was the cash sales? You get it from the trial balance. Yeah, cash sales was an amount of 36,000. What about the hire purchases? 270, right? Yeah, the higher purchase sales amounted to 270. How much is the total? For what? 406? 306? 346. Then you rest what? Cost of sales. How much is the cost of sales? For higher purchase, you already know that 270 is the same as 180. Therefore, 100 is how much? 150. So for the cash price, this is how you argue that 36 is the same as 150 per? Because we're selling at 150, right? Or about 100. We got 24, right? 24. And the total is 174. So give me the gross profit. Gross profit is an amount of? This is 12,000. This one is 120. And the total is 1, that 2. Then we deduct the expenses. For the expenses, number 1, we have unrealized profit. Unrealized profit, an amount of, now the increase. Where do you take it? Unrealized profit arises from the sales on credit. Are you together? Because we're looking, if we sell on cash, that will not affect our debtors account. And the one we have is based on the debtors. So the unrealized profit is a totally cost from the hire purchase. 49,896. 49,896. Do you have any other expense? General? Yeah, general operating expenses. General operating. How do you apportion that? First of all, let's go to note number 5. Note number 6, actually. Note number 6. Operating expenses are apportioned on the basis of cash and hire purchase what? Sales. Very simple. General operating expenses is an amount of 65 to apportion in the ratio. Actually, if you're not given that information, always use the sales. That 6 plus 270, which is 306, get the ratio. That 6 divided by 306, you get the proportion of the cash. Then you multiply by 65,000. You're getting how much? 26? 76, eh? Can you read for me? 76? 47, eh? Then can you give me for the hire purchase? Just take 65,000, you minus that. Sorry? 57? 353, and the total you get is 65. Then there's a depreciation. Depreciation. Note number what? Yeah, note number 5. In note number 5, you are told that. In note number 5, that depreciation is charged on property and property, plant, and equipment at the rate of 15% per annum on cost. 1/3 of the depreciation relates to. Yeah, so we provide depreciation at the rate of 15%. How much was the value of PPE? 50,000. How much is that? 75. Then of this 7,500, a third related to cash. A third of that is 2,500, right? 2,500 is cash. That means the other 5,000 is for, sorry, of interchange. 25, that's a third related to cash sales, and then the balance of 5,000 that means related to what? To hire purchase, and the total is 75. Any other expense? No. So now we can get our profits. Give me the profits. Which one are you getting? Which one? The first one is 50? 18. 1853. And what about this? Hey, for those with the answer, give me the answer. Don't stay with your calculator to not change. 77, 51. Now give me the combined. 90, 96.0. Yeah, 96.04. Let's go to the balance sheet. Yeah, statement of financial position. I think it will fit here. Ledger Limited. Statement of financial positions. As at 30th of September 2017. So we start with the assets. Non-current assets. We have PP. How much is the plant, property, and equipment? It's 50,000. Did you have any accumulated depreciation? Yes, there was accumulated depreciation at the beginning of the year. 22,500. Then there was a depreciation charge for the year, which was 7,500. So how much is our net book value? 20,000, right? Then we go to the current assets. Under the current assets, we have the receivable or debtors. For the debtors, you just take the balance carried down from the debtors account, which is 113,400. And then there was a provision for unrealized profit. How much was the provision for unrealized profit? It's not in the question, it's in the solution. Good. You take 54. Yeah, that's at the end of the year. Now, the changes is what you take the income statement, but the balance sheet you deduct 5,400. 5,400. So give me that. Sorry? 63,000, eh? Do you have any cash? Yeah, we have cash balance, right? Cash balance, an amount of? Yeah, that 104. Note that the cash received from the customer is not part of cash balance. Then there is inventory. We said, how do we get inventory? Let's be, yeah, we said that to get the cost of sale, it's opening stock plus purchases minus closing. So to make this the subject, to take it to the other side. So therefore, to get the closing stock, you take opening stock plus purchases minus cost of. How much was the opening stock? It was 7,500. Then we had purchases, 171. You raise the cost of sales. How much was the cost of sales? It's not there, it's here. How much is the cost of sales? Yeah, you take the total right together. Yeah, there was no repossession, 174. So how much would be a value of closing stock? That 500, right? That 500, right? 45. So 45. Let's go to the equity and liabilities. We had? Yeah, we have share capital. An amount of that 7,500. Then you also have, do we have retained earnings? Yes. Retained earnings, an amount of 500. Then you add 96. Yeah, 9604. 1310. 13,104. Then we go to the liabilities. The liabilities, what do we have? We have trade payables. How much is the trade payables? 40,000. Anything else? No. So let's try to harmonize that. You get? Asset liabilities. 90. 604. Liabilities. 9604. Good. No break. We continue. Are you okay up to that point? Yes. Can we do another illustration? Yes. So that was the sales method. Now I want us to do an illustration in relation to the other method, which is the interest method. And we say that under the interest method, the sales will be recognized as the cash price, and therefore interest should be computed as a separate item and recognized under part of other incomes. So interest method, we do the question from the handout. Handout page 41. Just look for the question on the hire purchase. In case you don't have that, the question is already written in the notes. You can either use the handout or the notes. So question number 2, that's on Kopesha. Kopesha Limited has been in business for several years, dealing in electronic goods. All goods are sold on hire purchase terms. The foreign trade balance was extracted from the books of the firm, not form, as at that 1st March 2016. So you have the ordinary share capital, cash at bank and in hand, account payable, operating expenses, PPE, at 1st April 2015. We have depreciation, hire purchase installment receivables. Those are the debtors. Hire purchase sales, purchases, inventory. That's the opening inventory. Additional information. Inventory as of that 1st March 2016 was valued at 2.4. So in this case, we're given the closing stock. Number 2, PPE should be depreciated at 5 million for the year ended that 1st March 2016. Also given the depreciation. Number 3, each unit was sold on hire purchase basis on the following terms. Cash price is 40,000, deposit is 10,000, interest of 6,000. So therefore, how much is our hire purchase price? So our hire purchase price is how much? An amount of? So we're given hire purchase. It's an amount of 46, right? So we say that, how do we get the hire? We say you take the cash price plus the interest. Are you together? How much is the cash price? You add the interest of how much? Good. So our purchase price is how much? 46. Now, under the interest method, we say that the interest will be computed separately and recognized as a part of other. And how much is the interest per unit? Mnaona ngapi? How much is the interest per unit? Now, what are you trying to read now? You can read the question and give me the interest. You can combine your knowledge. 5 common sense plus 5 common sense, you get 10 common sense. You should, you should come up with the answer. How much is the interest? Even if you are debating with your friend, you are debating the wrong thing. So you are given directly. Cash price 40. And then I ask you, how do you get the higher purchase price? When you ambia ni cash price plus the interest, na mkachukua 40 plus 6, mkanipia 46. Then I ask how much is the interest? Interest per unit is 6,000. Good. Number 4. Assume that all sales are made at the end of each quarter. 1 year has how many quarters? 4 quarters. That means quarter 1, quarter 2, quarter 3, quarter 4. So assume that all sales are made at the end of each quarter, and the quarter ends on that 1st March, June, September, and December respectively. The balance due on each hire purchase sales is payable in 4 equally installments. So they are paying in how many installments? 4 installments. So 1, 2, 3, 4. Those are 4 installments of 9,000 per quarter, payable at the end of each quarter and commencing in the quarter following that which the sales were made. Yeah, hiyo ni Kiingereza, rudia tena. And then we interpret what it means. Yeah, for those who went to group of schools, help us interpret that. You are good in talking in English, but not on interpreting it. What does it mean? Sorry? You're saying? Unanunua ikwota, unanunua ikwota una? Correct. That's what it means. So, can you read that paragraph again? That the balance due on each hire purchases is payable in 4 equal installments of 9,000 per quarter, payable at the end of each quarter, and commencing the quarter following that which the sales were made. So that means if you make a sale on the first quarter, the amount will be received at the end of quarter, commencing that of sale, following that of sale. What does it mean? The sales of quarter 1, the first installment will be received from at the end of quarter 2. Are we together? The sales in quarter 2, the first installment will be received commencing quarter 3. That's what it means. Good. The number of units sold during each of the quarter are as follows. So we're given the 4 quarters, the number of units, add the total 693. That's 1,200, right? Yes. Can you write 1,200 there? The total number of units was 1,200. Then number 5, you are told that the sum of digits method is used to apportion interest. Sum of squares, right? Here, sum of digits. This is how do you apply sum of digits? How many quarters? 4 quarters, right? So now, when using the sum of digits, we have 4 quarters. So you take 1 plus 2 plus 3 plus that's 10, right? Sum of digits. So let's determine that interest. Quarter 1, quarter 2, quarter 3, quarter 4. Quarter 1, how many units did we sold in quarter 1? 100 units. Are we together? And the interest per unit is how much? 6,000. Quarter 2 is sold 200 units. Interest of 6 per unit. Quarter 3, 300, 6, and then 600, 6. So you want to determine the total interest. This was 600, 1,200, 18, and 36. Now, can we now apportion using the sum of digits? Yes. How would we apportion that? Quarter 1, are we together? If you made the sales in quarter 1, you expect to receive the installment in the next 4 quarters. Are we together? 1, 2, 3, 4. In the first quarter, the total interest is so using the sum of digits, 4 over 10, 3 over 10, 2 over 10, 1 over. Yeah, that's what I explained when we started our class. Of these 600. So what it means is that the first quarter, the total interest was 6. On the first installment, they'll pay. How much will be your interest? So 40% of that is how much? 240, right? 3 over 10, that's 30%, right? 30% you get 1. 20% of that you get? 10% you get? So that means the sales you made on the first quarter, if you pay the first interest at the first installment, your interest will recognize how much? 240. On the second installment, your interest income will be 180. On the third installment, your interest income will be 120. And then on the last installment, your interest will be, let's do the same for quarter 2. 4/10, 3/10, 2/10, and the last installment. And the interest from the quarter 2 was 1,200. 40%, that's 248. 48, right? This one is 360. This one is 240. And this is 120. Let's go to quarter 3. Quarter 3. Yeah, let me show it. Yeah, quarter 3, you just take 4/10, 3/10, 2/10, 1/10. How much was the interest from the third quarter sales? 1,800. 180 times 4 divided by 10, that's 720, right? 4, 540, 360, and we have 180. And then lastly, quarter 4, 4/10, 3/10, 2/10, 1/10. The interest from quarter 4 sales was 36. 1440. 10/8, right? Sorry? 720. 720, and you have 360. And you can do it better reason. I see dropping some people on the way. So now let's allocate that interest. Now you want to determine the interest for the period. How much will you show to our income statement? Let me use an easier way. Quarter 1, quarter 2, quarter 3, quarter 4. Quarter 1, quarter 2, quarter 3, quarter 4. Let's start with the sales for quarter 1. But the reason here I'm not repeating. The sales on quarter 1, are you together? So you made the sale in quarter 1. The first installment you received from the second quarter. So, and the first installment to be received with an amount of 240. The other installment will be 180. The other installment will be 120. And then the sales of the fourth quarter will be received the first quarter of the next financial year. Are you together? Now let's go to sales of quarter 2. If we make the sales in quarter 2, are you together? That means the first installment received from quarter 3. And the sales of quarter 2, the first installment to be received becoming an interest of how much? So this one will be for 80. This one will have, and the last two next financial year. The sales of quarter 3, are we there? The first installment to be received from quarter, and the first installment from the sales of quarter 3 will be how much? 720. The other remaining 3 goes to the other financial year. The sales of quarter 4, will you receive anything in this financial year? No. So how much do we recognize as the interest for the year? And the total. Total interest for the year. $2,100, right? 100. Good. Let's go back to the question. Number 5, we are through with number 5. Let's go to number 6. Number 6. Included in the operating expenses is a lease rental payment of 2 million paid at the commencement of the financial year. This relates to equipment whose fair value is 8 million. The payment has been treated as an operating lease, whereas it's a finance lease. The duration of the lease is 5 years, and the interest is at the rate of 10% per annum. Lease rental are paid in advance. So this one you better just listen or just cram. So that one is require another concept of leases. Shall do it later. But whenever you are given a lease, I'm just mentioning, shall do it as a separate topic. Are you together? Yeah. Whenever you have a lease, you come up with amortization what? Yeah, for those doing a firm, they did loan amortization schedule. Actually, the same. Eh? You come up with an amortization schedule for only 2 years. Because in this case, we are presenting the financial statement. We are not accounting for the leases. And then we have leases payable in advance and leases payable in arrears. So how you account for them, they are totally different. So in this case, we are paying, is it in arrears or in advance? Lease rental are paid in advance? In advance. So in this case, we are paying in advance. So how do we account for it? Period. How many years? How many years? Just read the question. How many years? Now, let me tell you, if you want to prosper, listen to what I'm saying, eh? Not just cramming. I've just explained something. Eh? What have I said? I never said 3 years. Yes. I've said that for financial statement preparation purposes, you only prepare for 2 years? Yes, the list is for 5 years. I'll show you how to use that 5. Eh? But for you to prepare the financial statement, you only require to prepare for 2 years? Period 1, period 2. Then whenever you're paying in advance, you take balance brought down. Then you start with the payment because we're paying in advance. Then you determine now the balance due. Now the balance which will remain is what will give rise to the interest. Are you together? So you determine the interest, then you determine the principal, and then you determine the balance carried down. How much was the balance? Let's read note number what? Number 6. Included in the operating expense is a lease rental payment of 2 million paid at the commencement of financial. Now let's be here. Now the payments always even also when you take a loan, the amount payment is always the same. The same. So and the lease payment is how much? Yeah, for the 5 year, you're paying 2. Then you are told that this rate equipment whose fair value is 8 million. Yeah, the value of this equipment is 8 million. Then you are told that the payment has been treated as an operating lease, whereas it's a finance what? Finance lease. Therefore, you don't expense that amount. The duration for this is 5 years, and the interest is 10% per. So the interest is 10% per annum. Now let's be here. The fair value is 8 million. Then you pay immediately. That's in advance, 2 million. How much is your balance due? 6. So therefore, the interest is based on your balance due. 10% of 6 million is 600. How much is your principal? How do you get the principal? How much did you pay? How much did you pay? How much did you pay? 2. Now the payment includes the principal plus the interest. Of this payment of 2, you know the interest is how much? So therefore, how much was the principal? Yeah, you just take 2 million, I mean 2,000. You deduct first of all the interest. So the principal was an amount of 1,400. Are we together? Therefore, to get the balance carried down, is the opening balance 8 million. You deduct the principal. Are we together? Yeah, this interest was their income. So how much is that? You get 66. The balance carried down becomes the opening balance from the beginning of the second financial year, 6,600. Then you pay immediately. How much? So how much is your balance? 46. 10% of 46 is how much? How much is the principal? You paid them 2 million, but of this 2 million, the interest was 460. So how much is your principal? 15? 1540. Therefore, how much is your balance carried down? You take 6,600, deduct the principal. Sorry? 50/60, eh? Yes, now how do you account for this? What do you take the income statement? What do you take to the balance sheet? Now to the income statement, we focus on the first year. To the balance sheet, you focus on the second what? Second year. For the first year, what do you take to the income statement? We have 2 elements. One is the interest, and then depreciation. To the balance sheet, you have an element of non-current liability as well as current liability. So let's go to the income statement. How much is the interest? Interest is that 600. Good, I can see you are listening. Eh? Yeah, it's for the first thing. Yeah, this is the operation, the year in operation. Are you together? So to the income statement for the year ended. So you take the interest for the year, which is then depreciation. You take 8 million, and the rest is for 5 years. Yeah, for finance lease, you need to capitalize it. So you need to depreciate that asset. That's 1600. 1600. Now let's go to the balance sheet. To the balance sheet, what do you take to the non-current liability? What do you take to the current liability? So to the non-current liability, you take the balance due. Then to the current liability, you take the payment. What's the difference between a non-current liability and a current liability? Who can define for me what's a current liability? You want to try? Yeah, it's amount payable within 1 year. Yeah, in the next one financial year. What about non-current liability? What you're not able to pay within the next 1 year? Now, this is the year of operation, year 1. How much was the balance at the end of year 1? So whatever you're able to pay within the next one financial year becomes your current liability. Are you together? And in this case, our payment was how much in the next financial year? 2,000. That's what's go to the current liability. What you are not able to pay by the end of next year, that means becomes an non-current liability. It will take more than one financial year. 66, you paid 2 million. How much was the balance? You take it to the non-current liability. But note this, when you'll be doing for the leases payable in arrears, it will change. But that one will come when it comes to that. So meanwhile, just get that. Good. So now we can present the income statements. Required income statement. So this was Operation Limited. Income statement for the year ended. For the year ended 31st of December 2017. So our shillings are in thousands. So what do you have? Do you have the income statement? We have the sales, right? Let's go to the trial balance. So how much was this from the income statement? Just look at the income statement. I mean the trial balance. The sales is how much? Yeah, 48,000. Then you go to the cost of sales. How do you get the cost of sales? In this case, you're given both opening stock and the closing stock. So you take opening stock. You add what? Purchases, you raise what? Closing stock. How much is the opening stock? How much is the opening stock? 1,800, right? Yeah, 1,800. You add the purchases. Do you have the purchases? An amount of 24,600. You raise the closing stock. Number one, inventory as at that first March 2016 was valued at 24. So how much is your cost of sales? Is it 24,000? 24,000, right? So how much is your gross profit? 20. Do you have any question? Which question? Sales. How much of the sales? How much is the trial balance? So now let's be here. Let's be here. There's something I've been repeating. Now, I told you in my class, if you want to pass, don't just look what I'm doing. Kindly listen to what I'm saying. Are you together? Yes, because what I'm saying is more important than what I'm writing. Now, what's the difference between interest method and sales method? You have been keenly listening to me what I'm saying. It's something I've been repeating. We say that even you, I told you to underline, right? Can you go back to the interest method? That was the first method. You say that under this method, the sales are recognized at what? cash price. Are you together? How many units did we sold during the year? We sold 1,200 units. Are you together? Now let's be here. Our higher purchase was 40, was 46. Are you together? Now can you take 1,200? Take 1,200. You multiply by 46. You're getting 55. Is that the one in the trial balance? Sindio hiyo. But tumesema under this method, sales will be recognized at cash price. Then you take interest as a separate item and other. So you take 1,200. How much was the cash price? Yeah, just go to note number 3. The cash price was 40,000. So you recognize your sales at cash price. So 1,200 times 40, you get how much? 40. Tie together. Yeah, that's how you get the gross profit. Now, once you get the gross profit, we say that interest is computed separately and recognized as part of other income. So after gross profit, you had interest income. How much is the interest income? It's not there. That's what we have been doing here. How much was it? 21? Yeah, we have done all that work to get only 1 mark. 1 mark. Let's go to the expenses. To the expenses, what we have? Let's start with the one we have in the trial balance. We have operating. Yeah, operating expenses, an amount of 14,000. It's 16. Number 6. Number 6. Are you there? In number 6, there was a lease rental, including the operating expense. Yeah, that's not part of an operating expense. So you deduct that too, because we have done the amortization here. Are you together? Yes. Now, from that to what you're supposed to recognize is the interest and the aspect of depreciation. So we have interest expense. We say that the income statement take the interest expense an amount of 600. Then you also have depreciation, an amount of 1,600. Good. Any other expense? Do you have any other expense? Yes. Let's go to note number 2. PP should be depreciated at? Yeah, there is also depreciation of PP. You can add the two, or you can just put them separately. How much was it? 5 million. I don't think we have any other expense. So give me the profit. Give me the profit for the period. They made a profit of how much? Sorry? 49? 4,900. Now let's go to number 2. We present the statement of financial position. So allow me to wrap this. We wrap these workings. We just wanted to eliminate this. Anyone taking a screenshot? We have the notes. Yes, the time is over. So statement of financial position. So Corporation Limited. Statement of financial position. As at 31st December 2017. So our shillings are in thousands. So we start with the assets. Non-current assets. What do you have the non-current assets? What do you have to the non-current assets? Yeah, we have PP. PP, how much is the cost? 50? 55. Do you have accumulated depreciation? Yes, depreciation was an amount of 20, and then there was depreciation charge. Note number 2. Yeah, depreciation charge for the year was 5. 55 minus 25, you get what? That. Then, note number 6. There was an item of plant. Is it plant or equipment? It's an equipment. Yeah, when you raise an equipment, we shall come to that. When it's a finance risk, the receipt capitalizes the assets. So we have leased equipment had a fair value of 8 million, but there was a depreciation of how much? 16. So what do you get? 60? That's 64? Yeah. Then let's go to the current assets. What do we have in our current assets? We have cash. Yeah, just note the current assets. You only have 4 items: cash, and bank, receivable, inventory, and in case there is a prepayment. So when you're scanning for those items, just look for those 4 items. We have cash at bank, an amount of 1,800. Do we have debtors? Yes, hire purchase installment receivables. Receivables, an amount of 34. Then you raise 72. What do you get? Sorry? 20? 27. Now let's be here. Why do I got this 72? In the trial balance, how much was the recognized sales? 50? It was 50? Sales zilikuwa ngapi? 55? 200. That's also the sales. But in this case, we have recognized an amount of 40? 48. So there was overcharged debtors. 48. This was 55,200. So there's an overcharge of how much? Yeah, that's what I'm deducting. So, yeah, because if you recognize that 422, it will not match between the higher purchase and the other one. So receivable is 27,000. Then do we have inventory? Number 1. Number 1, you are given the closing stock. How much was the closing stock? 2,400, and then you factor in the interest receivable. That's the interest we made for the year. And how much was it? 21. Good. Let's go to the equity and liability. The equity and liability we have? Yeah, ordinary share capital. How much do you have the ordinary share capital? Yeah, 53,200. Then we have retained earnings. Can you see it? No, in case we don't have it, just add retained what? Yeah. Do you have any retained earnings? From the trial balance? From the trial balance, we don't have, right? Yeah, but during the year, you made a what? 49. 49. Then we go to the non-current liabilities. What do we have to the non-current liabilities? Sorry? Let's be here. We have lease obligation. Lease. Yeah, we have leased an item for 5 years, which does not belong to us. We capitalize it. So let's be here. Under the workings, to the non-current liability, there is obligation. We said we take the balance due, which is 46. Then we go to the current liabilities. Also under the current liabilities, we have the lease obligation. Lease obligation, an amount of? Yeah, 2,000. If we have debtors, do we have creditors? Yes. Can you see account payables? Yes. Account payables, an amount of how much? 5,000, right? Anything else? No, let's assume there is nothing. So can you try to harmonize that? Which one? 69? Yeah, 69, 700, 69, 700. And that's marked the end of higher purchase. How was it? The worst, But in last session, I said that you prepare yourself mentally and I told you to take coffee before you come. Yeah, but I think It was the best actually. Yeah, as compared to the other classes I've been teaching for the last, I think, 5 years. Munacheka? Yes, I've been teaching this. I have been avoiding it because once I start teaching students, they start sleeping. But today at least you are good. So actually the learning curve for today's class actually was higher as compared to all the other classes I've ever taught. So at least you have gotten something. Yes, if you participate, that means you're at least getting something. Good. So now in our next session, God willing, which topic do you want us to run?